Capital expenditures are the purchases or upgrades of physical assets that companies need for their operations. These may include land and improvements, building and improvements, furniture and fixtures, machinery and equipment, or vehicles. These are often referred to as fixed assets. The amount of fixed assets companies need is dependent upon the industry in which they operate. There are capital-intensive industries such as utilities or manufacturers. These type of companies require large amounts of land upon which they have large facilities. They have large amounts of machinery and equipment and vehicles. There are also industries that are less capital intensive. These are usually service firms such as accounting firms or law firms. Besides office space, usually the only type of physical assets these companies need are desks and computers for their employees. Businesses require ongoing investments in capital expenditures because assets break, they wear out, they become obsolete. Also, if businesses are growing, they may need to add larger facilities, more production equipment, or if they are hiring and increasing the number of employees, they need more office space, desks, or computers to house those employees. Capital expenditures are not expensed on a company's income statement. Rather, they are booked as assets on the company's balance sheet and then depreciated over their estimated useful life. The depreciation expense appears on the company's income statement. Depreciation expense is supposed to mimic the actual cost of the use of the asset during the periods in which it is used. A company may use book or tax depreciation or both. Book depreciation is basically straight line depreciation, which means the asset is depreciated evenly over its estimated useful life. Tax depreciation, which is also known as accelerated depreciation, depreciates the asset more quickly at the beginning of its life. There's a misconception among some business appraisers that capital expenditures and depreciation should be equal in a normalized cash flow forecast. While this is a simplifying assumption, it's often thought to have a nominal effect on value, and in certain instances this may be true. However, this assumption is usually only valid if there is no growth or inflation forecast in the cash flow model. But if there is a capital-intensive company, capital expenditures should always exceed depreciation in the terminal period of a cash flow forecast. This will account for the effects of inflation on the future capital expenditures or the amount of future capital expenditures that will be needed.